The world's most powerful double-engine coverage, where access meets expertise. Davos Brainstorm, 19th to 23rd January. Only on India Today and Business Today.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the latest edition of What's Hot, a show that focuses on the biggest buzz on the D Street on this fresh and new week. We are going to be putting the spotlight on a lot of buzzing factors, including both gold and silver, which have now clocked in their first record peak of 2026. So the going of these shiny metals is strong even in the new calendar year. So what do you expect going forward? What should your strategy be? That's something that we will be focusing on as well. Of course, we will also focus on some of the earnings that have already come in. Remember, it's the Q3 earnings season and the calendar is kick-starting with Avenue Supermarts and IREDA results that have already come over the weekend. And now we are going to be focusing on the big IT numbers that kick-start from today. Both TCS and HCL Technologies will be reporting their numbers, of course, after the market hours. But what are the big expectations throughout the course of the session today? Should you be taking any positions ahead of the earnings? What do you expect from the large IT pack is something that we will focus on. And of course, what are the big brokerage houses' expectations there is something that we will also discuss. Anand Rathi will also be reporting its numbers. That's another one that we will be focusing on. So let's quickly first welcome our guest on board. Mr. Abhishek Basumallick joins in from Shree Rama PMS. You've been watching him, hearing him all across in 2025 and now into the new year as well. Welcome to you, Abhishek ji, yet again. And the markets again are subdued. We are now seeing even levels of below 25,600, probably nearing 25,550 as well. So we've seen all across last week, the volatility led to about a 2.5% decline on the Nifty. We also did see that the Sensex dropped by anywhere over 2,200 points in just the last 5 trading sessions. Of course, a lot of this dampener came in from external shocks and the expectations as to what will happen on the tariff front, the uncertainties, the geopolitical risks that continue as well. Over the weekend again, geopolitics took center stage with Iran now coming in focus. A lot of these war-like situations yet again emerging. Give us an understanding first as to, is it like deja vu of what happened in 2025? Are you going to be seeing a similar fashion of move as far as the markets are concerned amidst all these volatilities?
So good morning to you and all your viewers. Very difficult to, forecast how geopolitics is going to play out. But I think one thing is certain, that as long as the US president continues to be there, which is another 3 years, things are going to be volatile. I think the tendency for the primary global power to disrupt economics, to disrupt business, politics. We've not seen this kind of thing before. So very difficult. Actually, we are, to an extent, looking at uncharted territories. Overnight, I was reading reports that there's this action being contemplated on the US Fed by the US Justice Department. So these are things which I don't recall having seen ever. Very difficult to call out what is going to happen, because every week the US president talks about some new country, whether it's Greenland, Cuba, Iran, something or the other keeps cropping up. And add to that, the older problems have not yet subsided. We still have problems that are going on in the Middle East. There's problem in the Russia-Ukraine continues. So we seem to be moving to an era of increased increased violence, increased defense kind of time compared to a pretty prolonged few decades of peace. So I think that's the challenge, and I think slowly we will all get used to this kind of a of turmoil, and then maybe that is going to dampen the sentiments. So you know, continuously seeing these kinds of spikes, at some point in time people will stop reacting to it, or react less to it.
Absolutely. You know what's happening amidst all this chaos globally and the external shocks is that the bullion prices are continuing to soar higher, despite what many analysts may see, gold and silver much ahead of fundamentals, or probably very swiftly and a sharp movement that we've already seen in 2025, a whopping 180% rally on silver, 80% rally on gold, and even now amidst all these geopolitical shocks, we are seeing continued buying action on gold and silver. Today, the spot gold prices globally are standing at $4,563 per ounce at the COMEX level. This is the first record peak that gold has clocked in, viewers, for 2026. Silver is at a record level of $83.5 an ounce as well. Remember, back home in India, you can see these prices somewhere around for gold, 1,40,450 rupees per 10 grams. For silver, it's hovering around 2,59,900 levels, and almost at 2,60,000 is what we had already seen the silver prices as well at. Now, given this kind of a situation, would you still believe, Abhishek ji, that probably it's still better to ride the winning trend in gold and silver, looking at all these geopolitical concerns, rather than Nifty, even if it would warrant valuation comfort vis-a-vis the other asset classes?
So, a couple of things. I think, gold, we should not couple gold and silver together as of now.
Yeah.
Maybe in the future, it might sort of get coupled, in the sense that gold is getting stored or being bought primarily in very, very large quantities by the central banks. So, what is happening is, globally, large countries used to keep their reserves in the US dollar, and that is slowly depleting and getting replaced by gold. You look at India, it's exactly doing the same thing. Our dollar reserves are slowly reducing, and gold is going up, and that is happening across the world. So gold, primarily, the primary driver is obviously the buying by the central banks, and obviously there is some amount of momentum driven buying by ETFs globally that's happening. Silver is more a sort of a piggyback kind of rally which is happening. Plus, there seems to be demand from solar and industry. But having said that, solar demand is not something which is new. It's not something that has come up 3 months back, right, or 6 months back, or a year back. Solar, cell production, etc. demand has been there for the last 4 or 5 years. So the question is, the narrative that is getting created for silver is actually a narrative, because the solar or the industry that was needing it remained the same, say 2 years back, 3 years back, and silver was not rallying at that point in time. So that's my take is that buying a little bit of gold, silver may not be a bad idea from a portfolio perspective. But again, these have run up a lot, and history tells us that when a particular asset class runs up a lot, then the next few years it tends to cool off. So whether that cool off happens this year or next year, I don't know, but it will.
Okay. What about the base metals, the likes of copper, aluminium? We are also seeing, these prices nearing record high levels. Do you think one should, in fact, shift focus from the precious metals to base metals, looking at the current, trends that are shaping up?
See, I think the entire focus is going to be moving away from paper assets to real assets. So whether it is metals, whether it is real estate, so all of these things. So people would want to put their money in stuff where they can see the value, and where dollar, etc., or currency movements do not make a big dent. So that is where we should be focusing on. So metals definitely is one area which likely to do well. In fact, another area which might do well is oil, which nobody is probably talking about now, since Venezuela has started or probably is going to start producing more oil. The expectation is that oil prices are going to go down, but I'm not very sure because my hunch is that oil prices could be headed higher from here.
Okay, got that. So oil prices, in fact, $63 per barrel is what we've seen today. What's the overview that you have there? Till what levels do you see oil prices surging to?
Not too much. I mean, maybe
Not too much.
yeah, so maybe 65 to 70, 68, $70. Not bad from an India perspective, but it's not going to go down further, is what my bet is.
Fair point. So that's how, viewers, the commodity play is shaping up as far as the geopolitics is concerned, and keep an eye out on that. This is a space that you don't want to overlook, at least at this point in time, looking at the everyday trends as they are shaping up, and already they're pointing at record high levels. So don't forget to keep one eye there. But let's come back to the D Street and find out where are the opportunities. The earnings is taking center stage. So let's try and understand on the earnings that have already come in. We have D-Mart, Avenue Supermarts that's reported the numbers. Revenue uptick of 13.3% to 18,100 crores. Net profit up 18% again at 855 crore rupees. EBITDA has improved 20%. To 1463 odd crore rupees. There's also an improvement on the margin front, and this is ahead of the street estimates there. 8.1% vis-a-vis 7.6% seen in Q3 of FY25. So let's try and understand what really is happening. Today the stock is up by 2.2%, reflecting on the good set of numbers that have come in. Are things turning back into and falling back in line as far as D-Mart is concerned? Would you again be a buyer after looking at these earnings?
So I think we need to understand what actually led to this margin growth. So I haven't actually gone into details of the numbers, and we need to listen to the management commentary. But ultimately, I think that is what is going to be key, is what actually drove these margins, whether it's reduction in discounts or more in-house products that they sold.
Yeah.
So that would probably give an indication as to what actually is happening in the company.
Absolutely. The sales per square foot have stood at 9,290 rupees vis-a-vis 9,317 rupees a year ago. That's slight dip. While the like-for-like growth for the quarter has come in at 5.6%, the company has continued to expand its store network, ending this quarter with 442 stores. Avenue Supermarts has added 10 stores during Q3, taking the total additions to 27 stores in the first 9 months of the fiscal year as well. Now, CLSA has reiterated its high conviction outperform onto the stock, and it has rated the stock with a target price of 6,185 rupees per share is what they have put the target as, which is a super bullish kind of a target that they have maintained here. The kind of expectations that brokerage houses are penciling in, do you think such kind of an upside should be played in from right now, or do you still feel that the competition from quick commerce firms is likely to keep a cap on how this prices really go from here?
I would tend to think so. I mean, the competition is actually very, very stiff. Growth is going to get constrained, so it's not something, and valuations are not that cheap. So I would be a little bit skeptical of thinking of very big upsides here.
Okay, got that. So that's as far as D-Mart is concerned. Let's also focus on IREDA. That's another one where a lot of retail investors' focus has been onto this stock right from the time the IPO had come in. It went up to even 300 plus kind of levels, and therefore over the last 6-8 months, a non-performance has pulled down the stock to around 140 odd levels, and that's really led to a lot of frustration among investors as well. Let's find out what the earnings have pointed out to. The stock is up by 2.8% post the earnings. Net profit is up by 38% at 584 crores. The revenue has risen by 25%, now coming in at 2,130 crores. The loan book for the company has also grown by 28%, now stands at 87,975 crores. The disbursements were up 32% this time. Gross NPA at 3.75% vis-a-vis 4.13%. This is on a sequential basis, so improvement on gross NPA. Net NPA at 1.68% vis-a-vis 1.97%. Again, a sequential improvement on the asset quality quality front as well. How would you assess IREDA? Do you think you can look at IREDA, expect for its prime levels kind of a rally also coming in again, or do you still feel there will be a lot of time and patience to be had there?
Uh, uh, I would again probably wait on IREDA or on all of these kinds of infrastructure, like power, etc. led companies, because we have the union budget coming up within the next 3 weeks, and we will get an idea in terms of what what the government is thinking in terms of infrastructure, because we have to understand that this is not like the last couple of years where the government finances are also constrained, and globally also the external world also is extremely volatile. So the ability of the government to allocate very large sums into various projects is going to be sort of constrained. So interesting, I think a large part of the infrastructure, power, roadways, all of this growth is going to be tied to this budget. So I would want to see the budget before committing additional capital to these any one of these sectors.
Okay. Abhishek ji, let's now focus on the earnings that are likely to come in today, and which will shape the entire narrative for the IT sector as a whole. The big IT players, TCS and HCL Tech, the bellwether giants, will be reporting their numbers today, and that's going to be of importance. For Q3, I'm going to be broadly highlighting for you what the street estimates are, and then we will go into a discussion with Abhishek ji to try and understand what should your strategy be ahead of these numbers there. So for Q3 for TCS, there's a revenue growth expectation of anywhere between 4 to 6% year on year. The revenue estimates stand at 66,000 to 67,000 odd crore rupees. The net profit is expected to rise anywhere between 1 to 6 odd % year on year. So there's a huge margin there that the expectation is. The profit range could be anywhere between 12,300 to 13,200 crores. EBIT margin is expected to be around 24.5 odd %. There are also brokerage houses that have specific expectations with regard to TCS. Nomura believes the revenue expectation to be at 66,326 crores. Profit at 12,298 crores. Margins 24.5%. Now, Motilal Oswal again has an expectation of revenue at 66,570 crores, profits at somewhere around 13,080 crores. The constant currency revenue growth expected to be around 0.5% sequentially, and that's what Motilal Oswal has penciled in. Axis Securities again, it expects higher band of revenue growth and expects the revenue to come in at 67,526 crores. Profit they again believe on a higher side, 13,163 odd crore rupees, and growth they believe completely will be driven by BFSI and the high-tech spaces there. For the deal pipeline, they believe the TCV is expected anywhere between 10 to 11 billion dollars. The possibility of a large telecom deal to really ramp up the kind of move there. The BSNL ramp up also might support the revenues. However, they believe the key trends to track would be BFSI demand outlook, the US Europe tech spending, the Gen AI deal traction, and the client cost optimization, and all of these factors is something that brokerage houses are penciling on. Abhishek ji, what would be the most important factor for you to really look at in the Q3 numbers as far as TCS is concerned?
See, I think like you mentioned, whatever these brokerage houses are actually trying to understand, I think everyone who's interested in the space have these same queries, whether what is happening with the US clients, what's happening on AI, either spending, or what is the kind of demand outlook on AI based applications, what the companies are doing, what is the deal flow traction like. So these are things that everybody is going to be looking forward to. I don't expect that there is going to be some great commentary that is coming out, that is going to come out from any one of these IT company managements, simply because they are going to be hearing from their clients, and everybody is reading the same news reports. Everybody is reading the same newspapers, listening to the same channels, and there is concern around all of these factors going around. So I don't see a huge amount of spending coming up. There is a lot of spending that is happening in the US on Gen AI, but that is not on the application front. So it's going to take time. I don't see things to be very gung ho. What is more likely is that there is going to be some amount of stabilization in terms of business inflows, and the exuberance in terms of increasing attrition, etc., that would die down. So a more stable kind of business. I would also be looking out for what the companies are talking about in terms of the workforce reduction, if any. What is the impact of AI on margins on the projects that they are bidding? So these are more of the things that I am going to be looking out for. But in general, not very high expectations from any one of these companies as of now.
Okay. Let me also highlight for all our viewers HCL Tech as well, and then maybe we can do a comparative study there. For HCL Tech, the Q3 results preview or the street expectations go as follows. The revenue growth here is expected to be anywhere between 11 to 12% year on year. Net profit growth is expected to be anywhere between 5 to 9% year on year. Margins are expected to grow by 100 basis points sequentially. There is an improvement that is truly expected there. The key investor focus will be on the progress towards 18 to 19% EBIT margin. What is the commentary around that? The deal pipeline, the conversion timelines, the discretionary IT spending outlook, the enterprise Gen AI adoption and AI-led growth there. Investments in engineering and R&D products will also be important to be seen. Specific brokerage houses expectations go as follows. Axis Securities has come out with its expectations of revenue growth for HCL Tech to be at 33,395 crores. This could show a 11.7% year-on-year growth. Net profit to come in at around 4,995 crores, a growth of 8.7% year-on-year. EBIT they expect to be at 6,378 crores, 9.5% growth year on year. EBIT margins they actually expect at 19.1% on the upper end, 187 basis points of a year on year growth. That's a bullish expectation from Axis. Kotak Institutional. On Q3 profit, they believe there could be a 5% year on year growth coming in at 4,835 crores. Revenue could be coming in at 33,338 crores, again 11.5% jump. This is similar to what Axis has also expected. Revenue growth, they actually expect a likely cut there from 3 to 5% growth to just about 3.5 to 4.5% growth. So slight, expectations of projections that could be lower. Services growth seen at anywhere between 4.5 to 5%. EBIT margin guidance, they believe 17 to 18% to be retained. Axis has a bullish stance there. Let's try and understand on HCL Tech. So far in the last couple of quarters or last 2 quarters that we've seen for the current fiscal year, it's HCL Tech numbers that have likely been slightly better off than its larger peers, TCS and Infosys. How would you assess this time around the earnings would come in?
I would expect similar, because a few years back HCL actually started on its journey of getting into some products that it bought a product portfolio from IBM. The product portfolio itself was actually quite old, but with it you get some foothold into some of these very large corporations which have these softwares in the installed base. So, then you can actually start servicing them, getting new clients, etc. So, HCL Tech has been doing things slightly differently from the other, bigger players. So, probably their results will not, their results will be slightly, again, structurally a little bit better than, the Infosys, TCS, Wipros of the world.
Okay, got that. If I have to ask you on a pecking order, what would your preference be in the IT space among all of these companies?
I wouldn't pick any one of these, big four companies. I would probably go with the mid-tier ones where there is a lot more specialization. They're working on very specific verticals. They have deep knowledge. So there are few good companies. We all know Persistent, we know Coforge, we know LTTS. A few of these kinds of companies actually are doing fairly good work in the domain that they are experts in.
Okay, fair point, Abhishek ji. Thank you then so much for being with us on the show. The clear call is rather than going for the big 4 or 5 IT players, go for specific, mid-cap, mid-tier IT firms that are focused on specific technologies, and that's where he expects the outperformance to lie in the Q3 earnings as well. Thank you so much. Appreciate your time and for sharing all these insights from commodities to D Street, all the expectations that we can draw as to what should be happening on the markets and where should your concentrated focus be, viewers. Slightly better off than what we started off this show with, 25,595. So we pulled up and are nearing 25,600 mark. Will there be continued volatility through the course of the session? That's something that we will continue to watch out for. So stay tuned on to Business Today Television. There's a lot more coming up on your screens. We have market conversations, we have earnings conversations following. So stay tuned. There's the action that continues to build up. Of course, I'll be back for 12 o'clock Daily Calls edition, where we answer all your stock related queries specifically on this show. So stay tuned for that as well.
There's a quiet but significant shift unfolding in South